Good afternoon. I was going to talk today about whether or not LMI is a good idea to pay, or you should sort of save a bit more money, get a bigger deposit, get your 20% deposit and avoid LMI. I generally bang on about avoiding LMI being a really great thing. I think I should probably clarify my position a bit better. LMI is dead money. It's an insurance premium you pay to the bank when you don't have a big enough deposit or you don't have enough equity in your property to borrow less than 80% of the value of your property. You need to pay what's called lender's mortgage insurance. It insures the bank so that if for some reason they sold your property on your behalf to close your mortgage, if the sale was less than what you owed on the mortgage, lender's mortgage insurance would pay the difference. So if they just can't recover the funds, LMI will kick in. That's all that is. It does nothing for you. It is an insurance policy you pay for the bank. Now, the reason I want to talk about it today, if you don't have a 20% deposit when you're buying a house, you are liable for LMI as soon as you have less than 20%. Thing is, the policy, LMI can cost thousands of dollars. I'm doing a scenario at the moment. We've got a $600,000 purchase. Deposit's only $60,000. They don't pay stamp duty because they're first home buyers. So their loan amount's going to be $540 on a $600,000 property, which is LVR of 90%. So those that don't know LVR, it's a loan to value ratio. So $540,000 of 600 is 90%. Based on that, with the lender I'm looking at for this client, the LMI is going to cost $13,000. It's a one-off payment, and it's a lot of money. It's dead. You'll never get it back, and that's a cost of obtaining funding. The alternative for the client is to keep saving while they rent. Now, this is where it gets a bit funny with LMI being dead as opposed to kind of being useful. If the clients do take the loan, do pay the LMI, they move into their house and start paying off their own house straight away. If the clients, however, decide they're going to save another $60,000, which is going to take them another 18 months, they'll actually spend in excess of $30,000 renting another house, which is also dead money because, you're not paying off something you own, you're just paying to live somewhere. So that's the trade-off, is basically the argument. For these clients, they've got their $13,000 LMI premium, or they can pay $25,000 in rent. So they end up $12,000 off. And in this scenario, LMI does work for them. Another situation where LMI gets a bit funny, and a lot of people kind of say, maybe LMI is not such a bad thing, is when you're buying investment properties. They suggest use as little deposit as you can, borrow as much as you can. Reason being, you can write off the interest cost on your investment property mortgage on your tax, which is all really well and good. You can also claim the LMI cost over a couple of years, I believe. I have to check that with an accountant, but everything's tax deductible, so it makes sense that you would use less of your cash, borrow as much as you can. The only time I think there's an issue borrowing LMI for an investment property, it really comes down to what your strategy is. For someone that wants to have an investment portfolio, let's say 5-6 properties, and they're buying their first property, what that client generally will want to do, they'll buy their first, get the growth from that first property. So they buy it for $400,000, it'll grow to $600,000. They'll withdraw that $140,000 of equity. They'll use that $140,000, and then they'll buy another investment property. If that client was to borrow, let's say they bought the first property and they borrowed 90%, so $400,000, they borrowed $360,000, it went to $600,000. They need to wait for the property to get the loan to value ratio below 80%. So because they've borrowed so high, they're relying on the growth of their property to be much higher. If they buy a $400,000 property and it goes by 10%, so it goes up to $440,000, and their loan is $360,000, they can't access any equity, and they've paid the LMI, and the property's dormant. It's you can't do much, so they kind of bottleneck themselves in a way. You really are relying on a high growth strategy there. That said, though, if you're happy with your 10%, you're happy with your one investment property, LMI maybe not such a bad thing, because it's not going to hinder your growth because you have got that high LVR. So it is really dependent on strategy. Look, that's it for today. I hadn't posted for a while, so thought I'd better do something really quickly while I had a chance. If you need anything, if you want to discuss this a bit more, by all means contact me. Thanks.